Today we're breaking down the difference between ETFs and index funds. And if you've ever looked this up and felt more confused than when you started, this video is for you. By the end of this video, you'll know exactly what each one is, how they're different, and which one makes the most sense for you. Most people think ETFs and index funds are basically the same thing. You'll hear that both are passive, low cost, and good for long-term investing. So it's easy to assume that the choice doesn't really matter. But the difference between ETFs and index funds does matter, especially when you start investing a good amount of money. The structure affects how you buy them, how you automate your investments, and how taxes work. And depending on your personality and your income, one is usually better than the other. I've invested in ETFs and index funds for a few years now, so I've had some time to see how the returns play out and the tax implications of both. So in this video, I'm going to break down what ETFs are, what index funds are, the differences between the two, the pros and cons of each, and then how to choose the right one for your situation. Before ETFs and index funds, investing usually meant buying individual stocks. You had to decide which companies to buy and when to buy and sell them. You also had to try and stay as calm as possible even when the market is volatile. The problem is most people are really bad at this, not because they're not smart, it's just because investing triggers emotions like fear and greed. In the 1960s and 70s, academic research started showing something really interesting. Most professional investors were not beating the market. And after the fees, many were doing worse than simple market returns. That's when the idea of index investing was born. In 1975, John Bogle launched the first publicly available index fund for everyday investors. It tracked the S&P 500, which are the 500 largest publicly traded companies in the United States. And the idea was pretty radical at the time. So instead of trying to beat the market, you're basically just buying the entire market. And instead of paying high fees to fund managers, the costs were really low. With this, you didn't have to focus on constant trading, you can really focus on just long-term consistency. At first, as you can imagine, Wall Street hated this idea. They said that it was un-American and that it would breed mediocrity. But over time, the data spoke for itself. The index funds were quietly outperforming the active fund managers. And because of this, as you can imagine, they became wildly popular in retirement accounts. So fast forward now to the 1990s, investors wanted the same index type of strategy, but with a little bit more flexibility. That's when ETFs, or exchange traded funds, entered the picture. The first major ETF launched in 1993, which was the SPDR S&P 500 ETF. Today, it's commonly referred to as the SPDR S&P 500 ETF. So now, instead of buying the index fund once per day, investors can now trade the index like a stock. ETFs combined indexing with real-time trading. They were also cheaper and a little bit more tax efficient. And so over the last 20 to 30 years, index funds and ETFs have exploded in popularity. And today, literally trillions of dollars are invested into them. So both were created to solve the same problem. Both wanted to give normal people access to market returns. And for most long-term investors like myself, they've really become the foundation for wealth building. Let's start with index funds. An index fund is a type of mutual fund that tracks a specific market index. And there are a variety of indexes to choose from. A common one is the S&P 500. You can also do a total US stock market index, and there are also international indexes that you can track. When you buy an index fund, you're buying a tiny piece of every single company within that index. And because of this, you lower your risk because you're not trying to bet on a specific winner, you're diversifying across the entire index. Index funds are priced once per day, and because of that, you don't see price changes throughout the day. You buy and sell at the end of day net asset value. Most index funds are designed for long-term investing, and they're kind of boring by design. And I don't mean that in a negative way at all. Honestly, usually boring is best when it comes to money. Index funds are commonly used in retirement accounts, and they're very easy to automate. You can set up monthly contributions, which encourages consistency. And consistency is one of the biggest predictors in determining who's going to be wealthy long-term. Now let's talk about ETFs. ETF stands for Exchange Traded Fund. Just like index funds, ETFs track market indexes. The main difference is how they trade. ETFs trade on the stock market just like individual stocks. And just like individual stocks, the price of an ETF changes throughout the day. That means that you can instantly buy and sell ETFs during market hours. You can place market orders, you can place limit orders, and you can track real-time price movement. Because of this, ETFs are very flexible. They're also a bit more tax efficient than index funds, and they're very popular in taxable brokerage accounts. So now let's highlight the key differences between ETFs and index funds. Index funds are typically bought in dollar amounts, so you invest either $100 or $500 or $1,000 at a time. ETFs are bought in shares, so you can buy 1 share, 10 shares, or even 5.5 shares if you have a brokerage that allows for fractional shares. The price of an index fund settles once per day, whereas an ETF trades in real time. Because of that, index funds make it harder to time the market, whereas ETFs make it a little easier to try and time the market, but if you watched my last investing video, you know I don't like that strategy. Index funds are super easy to automate, whereas ETFs require a bit more manual work. And index funds feel a little boring, honestly. You know, there's no price changes, whereas ETFs, they trade like a stock, so you see the price move every day, and some people like that. None of these differences between index funds and ETFs are inherently bad. It just depends on your individual temperament and your investing philosophy. Now that we went over the differences between ETFs and index funds, let's go through each one of them and discuss the pros and cons. Let's start with the benefits of index funds. Index funds are simple, they're boring, and they pretty much eliminate decision making from your investing. Index funds are very easy to automate. You can invest the same amount of money every single month into an index fund without having to worry about timing the market. Index funds are a great way to build up the habit of staying consistent with your investments. They reduce the temptation to trade, and they really encourage patience. Now let's talk about some of the downsides of index funds. You can't trade index funds intraday, which means you can't buy an index fund in the morning at one price and then sell in the afternoon at a different price. And so because of this, people say they're a little less flexible than ETFs. And in certain taxable brokerage accounts, index funds are slightly less tax efficient than ETFs. But honestly, for most people, that difference in tax savings is not really significant unless you're trading millions and millions of dollars. So I would say that it's not really a downside, but it is true. Now let's look at the benefits of ETFs. Probably the biggest benefit of ETFs is the flexibility. Like I said, you can buy and sell them throughout the day, just like a stock, and so a lot of people like this flexibility. This allows you to have a little bit more control on the price that you buy in at, but honestly, if you're automating your investments every single month anyway, it doesn't really matter. ETFs are great in taxable brokerage accounts, which are basically just your regular brokerage account, not Roth IRAs or IRAs, and that's because they can be a little bit more tax efficient than index funds. ETFs are also widely available. Most brokerages have hundreds, thousands of ETFs to choose from. So ETFs offer access to pretty much any market imaginable. So if you're interested in investing in energy or healthcare or rare earths or pharmaceuticals or even international stocks, there's probably tons of ETFs on your brokerage that allow you to do so. This allows you to invest in an entire industry without having to pick an individual company or an individual stock within that industry. This decreases your risk and immediately gives you diversification, which is one of the golden rules of investing. So now for some of the downsides of ETFs. Because of their structure, ETFs make it very tempting to want to overtrade. And so, like I said, they trade just like a stock. You can buy and sell them throughout the day. And so sometimes when the market is volatile or when you see big headlines in the news, you're going to want to feel the urge to want to do something. And that's usually the wrong thing to do. Another downside of ETFs is that a lot of brokerages don't allow you to set up recurring monthly buys. This is a big downside in my opinion because it requires a lot more effort and discipline on your end. Every month you'll actually have to manually go in and buy the ETF. If you want to invest every single month, that means that every single month you'll actually have to go into your brokerage and buy the ETF. And like I mentioned before, this opens the door for emotional decision making, which is never a good idea when it comes to investing. However, I have noticed recently that a lot of brokerages in the past few years are starting to offer fractional shares and recurring buys for ETFs, which is great. For example, I use Vanguard and Robinhood for most of my investing. And in Vanguard, I did notice recently that you can set up recurring buys for any Vanguard ETF. And in Robinhood, you can set up fractional shares and recurring buys for pretty much any ETF on their exchange. Now I'm gonna give you a quick breakdown on how to invest in each one of these. I talk in depth about setting up your investing accounts in a previous video, so check that out if you want a more step-by-step walkthrough. First, you'll obviously need a brokerage account, and so these are companies like Vanguard, Fidelity, Schwab. All of those are solid options. If you're investing in index funds, you have to go into your brokerage and find the index fund that you want to invest in. Once you find the index fund, set up automatic contributions or recurring buys, however they phrase it, and make sure that you're investing on a monthly schedule. The next step is the most important step, and that's to just leave it alone. Don't touch it, don't check it every day, just leave it alone. These index funds work really well in retirement accounts like Roth IRAs and traditional IRAs, so if you have one of those, I'd highly recommend investing in index funds. It removes decision fatigue and promotes consistency. If you're investing in ETFs, go to your brokerage account and find the ETF that you want to buy. If your brokerage allows it, set up monthly recurring buys or automatic contributions. If not, you're gonna have to manually go in every single month and place a market order or a limit order. A market order means that you're telling the brokerage, I wanna buy this ETF immediately at the best available price. This guarantees the execution of your buy. Just make sure that you have enough funds in your account, obviously. A limit order means that you're telling the brokerage, I wanna buy this ETF if it hits this price or lower. You enter the price that you would like to buy the ETF at. Just know that if the share doesn't hit that price, your trade will not go through. I'll do a deeper dive on different order types in a future video. The important thing to note here is that ETFs and index funds are not enemies. One isn't necessarily better than the other. It all depends on your financial situation and your temperament as an individual. Both are really good tools to achieve the same goal, and that goal is to build long-term wealth for you and your family. And at the end of the day, if you're looking at videos like this and learning about ETFs and index funds, you're probably on a great course. Here's an easy way to look at it. If you want automation and simplicity, index funds are hard to beat. If you want flexibility and a bit more tax efficiency, ETFs are probably the way to go. There is no wrong choice here. Really, the only wrong choice is overthinking it and not investing at all. Now that you understand the difference between ETFs and index funds, you might want to learn more about the personal investing plan that I'm using to get rich in my 30s, and I talk a lot about that in this video.